Everywhere you look in Accra, something is being built. People see cranes and assume demand. But construction activity is one of the worst signals for real market health. Let's get into it. In this video, I want to explain why activity doesn't necessarily equal demand and how investors misread this all the time. So we think more buildings, more buyers, more cranes, growth, busy roads, construction, booming market. But the construction reflects the capital intent and not the user demand, okay? Now, what do we mean by capital intent? It is about what the capital represents, or what forms of capital it is, where does it come from, and then what is it aimed for. Now, there are a variety of observations, studies, narratives that point to money laundering, right? Let's get that big elephant out the room. Inevitably, you can't deny its presence, and you can't deny its impact on what's happening in the sector as a whole. We have seen instances of people being held to account over their dealings and then that money going into real estate. But that's one thing. And the other thing is that when people are building, they're often shooting for 300% margins in these apartment buildings. They may build for 5 million, and once every unit is sold, they expect to make 12.5 or 15 million. So what does that mean? Not every unit has to be sold, and they don't care. Why should they? They're trying to make a profit. If they make 5 instead of the 15, instead of the 10 million, they've still made 5. So that means if there's a quarter of apartments or half the apartments that sit there empty, so be it. And what I have seen and observed is that there are some development and developers who are struggling to sell because the supply levels and the demand levels aren't matching. I've seen a couple of developers who are in the outskirts, less so on the kind of high-rise buildings, but homes, and they've priced ridiculously and relative to what the area is, and they haven't sold anything in 7-8 years. I've got examples of those. Not sold anything, like they've sold a certain amount and then there's the empty buildings for 7-8 years. They finished back in 2018 and they still haven't sold everything, okay? If it's a real booming market, everything gets sold, whether it be reapportioned to state entities like they do in the West. They don't have that here. So there's a challenge there around the perception of the markets and what have you. So the supply intention and the supply levels does not equal absorbed demand. So construction, what that really signals is that there is access to the capital. I see there's a large degree of speculative expectations. I see some people who operate in the middle market have their own network in which they sell to, and they're motivated buyers who have some degree of connection to Ghana or Accra. Because the thing is, what you've got to understand is the buyer profile of a Ghanaian diaspora is different, has a different risk appetite to the buyer profile of an African American, right? Because the Ghanaian diaspora knows the system has inherent inefficiencies, knows the system has inherent problems, and is willing to circumvent and navigate that with controlled risk and enter the market, right? Because they know possession is 9/10 of the law. When you have something, you have to build on it. If you come into dispute, you may have to fight it out. They have these guardrails. The other thing is that, the construction that you see is really about, yes, access to capital, speculative expectation, time-lagged decision. So someone may have decided to do a development 5 years ago, right? And they're coming to the point where it's completing or completed, and then there's other things that are happening around it that affect what's happening. And having confidence at the point of financing versus the point of today might be different. So by the time you see the building, the decision's already old. So I think the challenge is that Ghana exaggerates that illusion, because a lot of the capital is diaspora capital. Think about it as well, right? Last year, 2025, the inflows from the diaspora reached 6.3 billion, right, into Ghana. So there is decisions that are being made abroad, and they're not necessarily based on grounded data, they're based on narratives. So I've had clients recently who were modeling a potential investment decision, and they were modeling their baseline way higher than what the expectation was. So I was able to uncover that for them to make sure that they weren't going to plunge their money into something that was going to take 40 years to get a return, because that middle income is more lower middle income if you go shooting for occupancy, those kind of things. So that's something that is specific to Ghana. Also in Ghana, I think in general, there's kind of like a build first, test later model. Some people build units and then, just expect demand to come, and may not even just build units, do business. I remember I was in Pram Pram, really nice hotel, and there's this really massive playground area that they'd built and stuff like that, but there's nothing around them, right? So they're having to wait for the infrastructure to catch up around them. So some units are built before the demand is even proven. So it's not phased absorption of the demand, discipline around. It's just, we're building it, it's up. There's some places I've seen where assets are just not doing anything, right? And that's where I would say it's probably more illicit funds. Built a ground floor commercial and apartments and nothing's happening. So that's the other thing, and the price anchoring is around build cost. Build cost is always increasing, and that's why I think people might get frustrated with some of what I say sometimes, because of the sheer build cost that it takes to actually deliver some of these projects. Makes you, and not even the build cost, the hassle that people go through, permits, having to overpay in order to get things done in time, the cost of land, because the land is held by asset holders who set a price and don't want to budge, materials, the foreign exchange pain that can happen. That's all part of the overall experience, and the renter affordability. So many developments are priced to recover costs, but not to clear the market. Real healthy markets aren't measured by how much is being built, but it's actually how quickly the demand is being absorbed, right? How quickly they're coming off the market. I can see, if you look at Dubai, for example, and how quickly that absorption happens, it's crazy. So occupancy rates, time on market, rent to income ratios, all of which we've explored with Kuro, right, in our custom reports and also in our dashboard. And the knock-on effect where you see these kind of inefficient markets is empty but finished buildings. We see a lot of evidence of that. Discounts hidden behind the call price, units quietly sitting there for years. Now, the consequences of getting this wrong are quite severe, especially if you spent 30 years saving money to get the right decision. You'll have your capital locked in a non-performing asset. There's price inelasticity or stickiness despite there being weak demand. And developers tend to double down instead of adjusting because they've paid what they've paid to build the place. It's not really as solid as you would think. So construction could continue long after demand is broken because people have committed to this construction. So how we help investors read the market a little bit smarter is we look for better signals, right? So who is renting? What are the wage bands versus asking rents? What are the asking rent bands versus the population? What is the population growth by district? Are there any major corporate incentives or initiatives that are changing things? Are there any major state level incentives or projects that are changing things? Infrastructure announcements are one thing, but on the ground developments is another. That's another thing we look into. Quiet negotiations. I get a lot of stories where what's on the front of the tin is completely different to what someone's really ready to accept to pay. So some surface level activity can be very misleading. So in summary, cranes don't mean confidence. They mean someone once believed in a project and decided to finance it, and they now have to follow through. If you don't understand the end user or the end consumer, construction activity tells you almost nothing. So that's the kind of thing we stress test when we evaluate projects for clients. All right, guys, what do you think? Does construction mask the real story, or is it a fair reflection? Let me know in the comments below. Until next time.